is right now, or on that side?
So basically, we cannot, we have guided for the full year on basis, but, telling specifically on a quarter-on-quarter basis, we are restraining ourselves from guiding on a quarter-on-quarter basis.
Full year is 90 working.
Full year is broadly 90 working days.
Okay. Thank you, sir. Thank you.
Thank you. The next question is from the line of Abhishek Datta from Anand Rathi Shares. Please go ahead.
Sir, congratulations on great set of numbers. Just had one clarification I needed. It's like in the presentation you have mentioned about value unlocking to EPC arm and value enhancement to hybridization of common infrastructure. So what exactly you mean by that?
So, again, you want to go? Yeah, so basically, whatever assets that we have, they can firstly further be utilized for the enhanced capacity on the solar side. I mean, obviously, these infrastructures are there and can be enhanced. So that's number one, which is an immediate use that we can, we can see on this. Also, you can see that lot of assets are there, which are in the books of green. So what we are trying to do is to demerge those assets into our EPC company called RESCO. And within that RESCO, obviously, because the assets would be demerged, it would be auto listed. Now, obviously, all these proposals are at a very nascent stage. The board has decided to appoint the consultant and the registered valuator at this juncture. And once we have the final scheme, we'll come back to you. And to that extent, it would take around 6 to 9 months' time, which is what we are assuming as a time period. Just to add, I think we see tremendous value creation opportunities across the EPC arm. I think we are the top 2 wind EPC companies. This is something which is a very, very strong moat. As I mentioned in one of my answers earlier, solar EPC, you've got hundreds of players doing. There is no rocket science to it, and I don't mean to disrespect anybody. Wind is very, very complex. It's very challenging. It's taken us years to build this competency, this capability. And what we are now doing is, given the massive multi-decade opportunity we have ahead of us, we are, if I may say so, backward integrating into capturing more value within the EPC arm. So we are getting our own cranes. The returns are phenomenal. The payback periods are phenomenal. We are evaluating various other assets to be added within the EPC arm where returns are phenomenal. For example, we buy transformers. Our transformers and cable procurement is almost 400 to 500 crores in a year, given the run rates which we would be on in the coming financial year. We are evaluating whether it makes sense to buy out some of these things, to get into it, to manufacture that in-house. Cranes, as I mentioned, is one key area we are anyways moving into internally. So it's just that we want to unlock value across the EPC capability we've built, also capture more value across some of the key components of EPC, where margins are very, very high with very low barriers to entry, at least for us. And third, I think we sit on over 5 gigawatts of project site inventory and land bank, which frankly is not given any due importance or value in reality terms, and that's worth a couple of thousand crores, honestly. So by shunting out the power evacuation from Inox Green, not only do we make the Inox Green balance sheet very light and eliminate the depreciation line, which impacts profitability, but by merging that into the RESCO, which is our EPC arm, it leads to automatic listing and creating tremendous incremental value for the larger Inox Wind Group. Of course, it's subject to board approval, but that's what we are thinking of.
Okay. But at no point you are planning to execute other wind EPC projects?
There is no question. I mentioned that in my to one of the previous questions. It is a very, very strong moat for us. There is no question of giving a strong moat which we own to other third-party players. There is no question. It's absolutely ruled out. We may give equipment if we get into manufacturing of equipment or give out cranes on rent, but there is no question of sharing our EPC capabilities, knowledge, land banks with other wind OEMs.
Okay, but just to get it right, like cranes, already we have players who are leasing the cranes to the EPC players. Now you want to buy those cranes and do it in-house.
That's right, because the returns are phenomenal. And given the multi-decade opportunity, if we see 30% plus returns on investment, there is no question of us letting that opportunity go out to third-party players.
Okay. And in the near term, how do you see the PSU order book shaping up?
I think PSUs, there are a lot of PSU bids still coming, and I can see that there is a huge impetus from different PSUs, and a lot of tenders are, as I see, coming up. So, while as I said, that C&I business continues to build up, but at the same time, we have executed and we are still executing projects like NTPC. We have separate bidded already, possibly more than 200, 300 megawatt for separate, different PSUs. And at the same time, we are in the process of bidding as we speak over next couple of months. So I would say that PSUs will continue to take some, important pie from our business.
I think just to add to Kailash, I think historically we had if you go back about a year and a half, we had a lot of dependence only on NTPC, and it was a carefully crafted strategy for us to move away and diversify from NTPC to other customers. And I think if you see over the past 12 months, we've gone out and added close to 2 gigawatts. This is across the private sector. That does not mean we're not focusing on PSU, but I think we had built too much of a portion in PSU when we were getting out of the bad state the industry was in. So it was important to pick up those tenders. As we are moving forward, we are selectively bidding in PSU tenders and diversifying that across different PSUs, as opposed to having too much concentration only on one PSU.
One more thing, like you are looking to set up a new manufacturing unit for Nacelle and Hub. So what is the rationale, given the fact that our capacity is over 2.5 gigawatt and we are currently targeting to deliver 800 megawatt and 1200 megawatt over next two financial year? What is the rationale to expand capacity? I know it is the lease expenses are much lesser, but what is the rationale for that?
It's simple. I think we mentioned there is an upside bias to the execution guidance for FY26. And I think this will be evident from the massive order inflows. We're sitting on the highest ever order book in the company's history. Perhaps you missed that. Kailash mentioned that in his opening remarks. There's almost a gigawatt which is in advanced stages of negotiation and discussion in the near future. Now, we've set out a vision of making it a 2 gigawatt company in the near future. Now, effectively, every quarter is not going to be the same as every other quarter. As is well known in this sector, Q1 is the weakest. Q2 gets more or less in sync with Q1, given that there is monsoon, and Q3, Q4 are very large. Yes, it's no longer a Q4 syndrome like in the feed-in tariff regime where 80% of the market was Q4, but certainly it could be 35-65, H1 and 65 H2, broadly. Now within that piece, if our capacity of manufacturing is say 2.5 gigawatt or 2 gigawatt, and we've produced 300 megawatt, for example, in Q1 and 300 megawatt in Q2, effectively we are left with only another gigawatt for the full year. So what should we do? Not produce turbines? And keeping the future in mind, we are taking decisions well ahead of time to play this multi-decadal opportunity. Again, if you notice, we've not announced 200, 300, 400 crores of capexes on our manufacturing plants. It's under the lease model where the outgo for the company at peak is 4 crores per annum.
Okay. And so what will be the capex for this year?
I'm sorry to interrupt, sir. I just request you to follow
this is a conclusion to that. What will be the capex for this year?
So it will be around 50 to 75 crores.
And next year?
Similar levels.
Okay. Thank you so much, and that's it, sir.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all the participants in the conference, please limit your question to 2 questions per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Anuj Upadhyay from Investec Capital Services. Please go ahead.
Yeah, hi. Thank you. So how much NCRPS will remain with the company post-merger, and what would be our plan for the same?
So basically, the NCPRS held between IWEL and the company will be squared off, because the two companies are getting merged, so it will be squared off. So post merger, the NCPRS which are outside this merger will remain, which is of the order of around 560 crores.
560 crores.
Yes.
Okay, so and how do we plan to?
Sorry, what you see as the current figure, which is, if I'm not mistaken, around 2,000 crores, it would be restricted to 560 crores, because as I mentioned, the effect of the merger would be that majority of these will be squared off or cancelled, because it would be within the same company then.
And the plan on the balance one, you mentioned that 560, 580 would still remain. How do we plan, the promoters plan to?
So as and when there are surplus cash flows in the company, as and when there are liquidity in the company which are not meant for any other use, it would be retired. I mean, that's our ultimate aim. As it is, there is if I am not mistaken, around 3 years time, end in end for us to redeem it.
Just to add, I think the maturity is till 2027. The promoters pumped in this money with no return expectations whatsoever, so they are in no hurry to take back the funds. As and when we see there's abundant liquidity far beyond what we need, then we will retire these NCPRs.
Okay. And so what market share are we targeting going ahead? Factoring, now the entire wind market side has gone up to from 2 gigawatt hour level to nearly 7 to 8 gigawatt on an annual basis. One is this, and that current capacity which we have, how much can we execute or intake order on an annual basis?
So what we believe that market will be closer to 5 gigawatt in 2025 and possibly go 7 to 8 gigawatt in FY26. And as we highlighted in presentation also, and we have talked earlier also, ultimately we are gunning like in 26, something like closer to 2 gigawatt or next year 1.2 gigawatt. So, you can roughly work out it will be closer to 20-25%. But again, we are focused on profitability rather than market share. I won't keep increasing and keep taking all kind of orders. We will be taking orders which are meaningful. There is an easiness in terms of execution and at the same time decent profitability. And we will take our fair share of select high quality orders with the marquee customers only. And we will not go everywhere. So that will be our philosophy.
I can only say market share does not guide us. It's profitability, as Kailash mentioned. And obviously, as the market goes beyond 5 gigawatt to 6, 7, 8, we will take our fair share of the market. I mean, we probably have the highest promoter holding across OEMs in India. We have a rock solid balance sheet. So there is no question of us not taking our fair share of market.
Sure, sir. And just one clarification on a question by a previous participant. The 50-60 crore capex you mentioned is your routine capex, or is the capex we plan to incur on the newly launched or planned Ahmedabad missile plant?
Yeah, just to clarify, our 50 to 75 crore capex is for molds, which we keep buying as we launch better products or larger blades. The new capex we have zero capex on the new Ahmedabad plant for nacelles and hubs. It's under the OPEX lease model. So the cost there is sub 4 crores per annum, which will be an OPEX. There is no capex. We are spending zero in terms of capex of that plant.
Thanks for the same, sir.
Thank you. The next question is from the line of Sanjay Kular from ACME Private Limited. Please go ahead.
Yeah, okay. Thanks for taking my question. Mr. Jain, first of all, I would like to compliment to you and your team for extraordinary turnaround and rewarding shareholders with a liberal bonus issue in the first year of turnaround itself. You are truly visionary next-gen entrepreneur who has created unprecedented wealth on the street. My question is only one, which is very simple. What is the key differentiator we will have with our peer group company, in terms of execution or in terms of profitability? Would you like to share some thoughts? Thanks.
Thank you, Sanjay. Thank you for your kind words. Look, this is not a dissing session or a punching bag session. All I would say is I think there are possibly just two domestic players who are large, who survived, who are growing. But possibly one thing which I believe is different from others is for us, credibility and reputation and financial management is absolutely critical.
Okay.
6 years of pain in this sector. We struggled for almost 3,000 crores of losses, haircuts, left, right and center payments to banks, but not a single rupee of haircut, not a single restructuring. The promoters were undergoing a split. We pumped in money, whatever we could, as much as we could, with zero return expectation to the promoters, and it continues to remain in the company. Of course, it's different that the company is now on a massive growth track and is financially strong. Having said that, for us, credibility, reputation, and financial management is absolutely topmost priority. Other than that, everyone's going to be plus minus in terms of technology, in terms of supply chain, in terms of order book, in terms of X, Y, Z. And I think the third differentiating factor for us is we are net cash now. And a lot of people have asked, I hope you're not going to get into a bidding war. I hope you don't get into stupid decision making. And I think to some extent, I think the entire management team here is absolutely clear, be it Mathu, be it Kailash, be it Rahul, be it Akhil, all our core people. We are in no urgency to deploy capital at absurd rates, at no paybacks. For us, fundamentally, profit aana chahiye. Market cap is temporary. I don't know what the market cap will be today, tomorrow, day after. But cash flow and profitability is the most important thing for us, which is reflected in the fact that we're going into our own trains because the returns are north of 30%. So there is no question of us not doing something which gives us 30% returns. At the same time, some people have asked us questions about certain acquisitions, certain OEMs in the market space. We're not going to go and do anything stupid for market cap reasons or for reasons which give us a 5% return on capital or a absolutely irrelevant visibility in terms of return on what we've deployed. I think that's also reflected in one of the acquisitions we had done in our sister company Inox Green, where we went in and bought out iFox, IPP, an OEM, it was a third-party ISP, O&M service provider. We bought it at 4 times EBITDA. And in 1 year, the team has doubled the EBITDA and top line of that company. We're on track for that. And we bought it at a 4-time EBITDA multiple. So some people would be happy paying 10, 20, 30, 40 times. Best of luck to them. That's not how we work.
Thank you very much for sharing your thoughts. Thank you.
Thank you. The last question is from the line of Pratik Giri from Shubhlab Research. Please go ahead.
Hi, am I audible?
Yes, you are.
Hi, Devansh. Congratulations to the entire team, for amazing set of numbers. Whatever has been promised, it seems, we are on track to deliver that. My question to Kailash is, Kailash, we have been, since last 3 quarters, we have seen, our margins beyond 18%, 18, 19 and 21 this quarter. That too, in these 3 quarters, our realization has not crossed 5 crore rupees per megawatt. But still we have made, handsome margin. So I am just wondering what is holding us, from revising our margin guidance. I'm not asking you to revise it, but still, if you can, help us with some color, Kailash.
Rahul can answer this.
Yeah. Hi. So we are still to actually realize the revenues from the EPC business. Around 110 megawatt is being stuck due to the grid approvals. So actually you will see those kind of revenues once we see that EPC revenues realizing.
So broadly we have given the guidance 16%, that it could be a little bit higher also, but we are currently sticking to that guidance only.
And quarter-on-quarter, it can vary, but yearly it will be 15%.
No, I totally understand. But since last 3 quarters, gentlemen, the margins have been crossing that, and the realization has also been low. So, I mean, how should we look into it then?
I mean, again, I think everyone is guided. We've mentioned as a company, we're saying, look at it as 6 crores per megawatt. We've given a volume guidance. That's what we will stick to. And, I mean, making more profit is not something which is bad. But at the end of the day, we will continue guiding for 15 to 16%. We are not upping our guidance at this point in time.
Understood. Point taken. Good luck, and, again, congratulations once again, to all of you. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today's conference. On behalf of Investec Capital Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.